Hello financial fans, welcome back to another stock analysis. Today we'll be covering the Coca Cola Company stock ticker KO. Coca Cola is a renowned multinational beverage company that specializes in the production, distribution, and marketing of a diverse range of carbonated and non-carbonated beverages. With a rich history spanning over a century, the company has become synonymous with its flagship product Coca Cola, a beloved soft drink that is enjoyed by millions of people worldwide. In addition to its iconic cola, Coca Cola offers a portfolio of other popular brands including Sprite, Fanta, Dasani, and Powerade, among others. Through its extensive distribution network and strategic partnerships, Coca Cola strives to provide refreshing and enjoyable beverage experiences to consumers in various countries and cultures around the globe. The company is currently sitting at a market cap of $267 billion, and in 2022 they generated a revenue of $43 billion, and they're a dividend king with their 60 years of dividend increases. 34% of their revenue comes from North America, 17% from EMEA, which is Europe, Middle East, and Africa, 12% from Asia Pacific, 11% from Latin America, 7% from global ventures, and remaining 19% from bottling investments. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT of Coca Cola has gone up over the years, going from $11.1 billion in 2012 to $12.2 billion in 2022. The average EBIT growth during this period was only 1.8%, which is a 5% increase in the margin of safety. The margin has also gone up over the years, going from 23.7% in 2012 to 28.5% in 2022. The average margin growth is 2.3% on average, which is a 5% margin of safety deduction. The next two ratios are the dividend growth and the payout ratio. The dividend has gone up over the years, going from $1.12 a share in 2013 to $1.84 a share in 2023. The average dividend growth during this period was 4.3%, which is no change in the margin of safety. This with a payout ratio that is currently sitting at 78%, which is no change in the margin of safety on this metric once again. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt, and for Coca Cola this is just over 2 years. This is a 204% debt to EBITDA ratio, which is no change in the margin of safety on this metric. The return on invested capital for Coca Cola is sitting at a very solid 13%, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Coca Cola. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Coca Cola going from 2014 to 2022. The average growth rate in their free cash flow annually during this period was just over 4%, and I'm projecting this 4% once again for the next 10 years in their free cash flow growth rate. With this percentage, we'll determine the future free cash flow for Coca Cola and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8%, giving them a sum of free cash flow of $202.5 billion. All that's left to do to get an equity value is to add the cash and equivalents and subtract the debt, giving us an equity value of just under $175 billion. Then dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $40.49, which is a 34.34% downside of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Coca Cola going from 4 years ago to the current year. The average growth rate in the dividends during this period was just over 3.5%, and I'm projecting an expected growth rate in all of their future dividends of 4%. I will once again be using a discount rate of 8% in this valuation, giving us a dividend discount model price per share of $47.84, which is a 22.43% downside out of this model. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Coca Cola is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a company with no growth should not exceed a PE of 7. And looking at all of these metrics, you get a fair value of this model of $29.51, which is a 52% downside from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Coca Cola, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 39.34. Multiplying this with the earnings per share that Coca Cola is generating, which is $2.27 a share, we get a fair value of $89.31, which is a 44.8% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that the company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years. On an average, it has been sitting at 3.05%, while the current yield is sitting at 3.04%, indicating that's trading very close to fair value on this metric currently. Doing the same with the PE ratio, on average, of the past 5 years, it has been sitting at 26.98, while the current PE ratio is 26.63, indicating that's once again very close to fair value. And then we get a value out of this model of $61.97. And with the current price of $61.67, it's trading very close to fair value with only an upside of 0.5%. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory prices per share, giving us an average of $53.82. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the EBIT growth, deducting 5% for the margin growth, and deducting 5% for the return on invested capital, giving us a margin of safety of 20%. Applying this margin of safety, we get a fair value of $43.06, and with the current price of $61.67, we get a downside of 30%, indicating that's currently a sell. But you have to take into account that companies that are dividend kings, such as Coca Cola, will always have a premium applied to their price. So just keep that in mind. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.